sold 10 Amazon 1780, 1785 call vertical for 23 cents. We placed that trade on Thursday, 12/5, and expired Friday on 12/6. So the first question everyone should ask is, why are we placing a call vertical, which suggests that Amazon trades sideways to down in a huge bullish market? Well, let's take a look at the relative strength of Amazon and see what makes sense. So if we remember that Amazon itself is in what's known as the SPX sector, consumer discretionary, that's here, XLY. And when we compare that as it's performing to the SPX 500, you can see that we're moving downward. We can see right here that SPX is not moving. I'm sorry, Amazon's not moving with SPX, it's kind of trailing sideways. And if we kind of scroll down even a little bit further and take a look at the next subsectors, we look at what industry that Amazon is in. And in the retail industry, you can see here that we are just basically moving flat. But that industry, of course, with the retail sector is moving down with XLY. Amazon within that industry group is moving down even further. So it's saying it's one of the weaker retail stocks. And of course, compared directly to the S&P 500, it's down. So what this says is not exactly let's take the trade, but it says, hey, let's take a possibility of what that may mean. So let's go and dive in on the technicals and see how, why, and where we may want to place a call vertical. So let's get out of this and let's dive back to our thicker swim charts. And here we have Amazon on a daily chart. And let's get orientated first. The biggest thing we want to see is that we have a number of different moving averages. So these moving averages also help us with kind of support and resistance. And we see here the red is the 200, this yellow is the 8, the blue is the 21, and the white's the 50. Okay, so one of the key things that you can see right now is that at this point in time, that these are all stacked, right? The 8's below the 21, 21's below the 50, 50 is below the 200. So that tells you from a trend standpoint that we're definitely trending down. So there's another reinforcement that says we have a potential edge. The next thing we want to look at is what are known as value areas. Let me drop back a little bit here. So a value area represents the volume, in this case for a monthly time frame. This is right here, right? For a monthly time frame, that within that month, that 70% of all the volume traded between this volume area high and this value area low. And we had a point of control. This is where the most volume is traded, right at this level. Now, a key thing about these point of controls is that if they're not taken out, they serve as a magnet. And you can see right here that Amazon, bounced at the bottom of the value area low, came all the way through, and where did it stop? It stopped right here on the point of control. And that's important because we're going to use that to take a look at the smaller time frame. So with that context, we can see that Amazon has been getting above a key moving average, right? Kind of a look above, if you will, right here. And then as soon as it takes a look above, what does it do? It's been dropping. So again, same thing with the 200, that's right here. Then we had it right here at the 50, right? Took a look above, failed, took a look below. That's a very bearish sign. So if that's happening, it's like, okay, we can see what's going on. We definitely would like to say we have the potential of putting on a call spread. So the question is where? So let's go down to a smaller time frame and get a little more granular. And we'll go down to the hourly and we'll show where we make our overall decisions and why. So we come down here and we'll go to the hourly profile. And our profile here on the hourly now is that we set these value areas up for the week, right? For the past week. And as you could see when we were setting this up, right, here we are, we bounced above the 50. I just brought the 50 on here and we started coming down below. So the question is, how far below are we going to go, right? At this stage, this value area is not complete yet, right? Because this week is not up. This is the current week. So we take a look to the left, because we always look at the left of the chart to make ourselves right, okay? And you know what? We had this virgin point of control, which serves as a magnet or a target. So here we are on the 4th, right, on Thursday, and we see that we're breaking this low. And we're like, if it's going to break this low, how far is it going to go? Well, it's going to go to this magnet right here. And sure enough, it went almost all the way down. So that gives us a really good indication that momentum is down, right? Shows it right here. Momentum is down. It's below zero. It's trending lower. And that this still has a little bit lower to go, and that we probably have an ability then to set a call spread. So where are we going to set that call spread? So the key thing is, hey, let's set above some natural resistance areas. So those key resistance areas are the following, okay? Number one, right, the previous high. You can see we have this high, so above 1763. I brought the 50 EMA over from the daily, and I transposed it here on the hourly. Let's make it sure here. And if you happen to remember that if you take a look at, we had a cluster of our, let's go ahead and zoom in really tight here. And you'll see that we have a cluster of these moving averages right here. So we have a break, right? That previous high corresponded with the 8 EMA. Then has to get through the 21 EMA. Then it would have to get across the 50 EMA, right, in order to reach our strike. So that's why we set it at a 1780, 1785 call vertical. It expired worthless. You can see on Friday what happened. We kind of, hit this target area on the VPOC, right? And it bounced a little bit, but nothing compared to the market itself. And, closed at 1750. We had 30 points here, and we're in good shape. We're able to capture, the entire premium, which is 23 cents. So if we sold 10 contracts, that put $230 into your pocket at about a 5% rate of return. Not bad for 10 or 11 hours worth of work. Okay, so that being set aside, I also talked about as we go forward, we want to take a look at more what the market's going to do from a longer term standpoint to kind of manage our more investment portfolios, right? And these are investment. This is not trading. These are your IRAs, those types of things. So we're going to be calling this on the brink. And so I just want to kind of give you a flavor of where we're headed, not the full boat. Don't want to overload you, but take a step of the kind of things that we're looking at and why these things are important. So let's go ahead and do that. Let's jump back over to another area. So let's take a look at the S&P 500 from a daily perspective and see what's really happening here. All right, so the middle chart right here, this is the S&P 500. We're taking a look at it right here. Okay, this chart, we can see that the 50 EMA, right, that moving average is up, that 200 is up. Okay, this is telling us that we're in really good shape. Okay, again, we have our stack, right? The 50 is above the 200, price is above the 50. That means we're in pretty decent shape overall, right? But there are some hints here. There's a couple different hints, and one is the overall momentum. If we take a look at momentum, and we take a look at it right here, we can see that we're kind of coming up to all-time highs, and that momentum is not crossed back above its indicator line. So we're not really moving as hard or as fast as we could or as we should. And it's showing us that, so we need to take a little bit of pause. And what that pause is telling us to do from a long-term money management standpoint is, hey, let's move our stops up a little bit, right? We're still green, but we don't want to be buying here at this top, all right? That's not what's happening. Now, let's take a look at what else is going on. If we kind of, come down a little bit lower. And what this is right here, this is the VIX. The VIX is really known as kind of the fear factor, right? We're looking at between fear and greed. And the VIX goes up, okay, when there's more fear, and it goes down when there's less fear. And what we're looking at right here is kind of a correlation between the VIX and the S&P 500. And we can see that every single time, not every time, but mostly, when we start to cross that correlation, when things get together at this point above this green line, and we kind of look above, is that we start to get shorts in the market, right? All these different areas here. Now we had one here, and that was kind of, it never got to the green. It was just saying, hey, just take a look at it. But right now we're down. We're not even close to this area. So what does that say? It says, hey, let's do what we just talked about. Let's stay where we are, maintain your portfolio, maybe move up your stops a little bit, and things should be decent. Now, why? Why is this happening? What's really driving the market? Well, there are really two things that are driving the market right now. One is the overall, I should say, hope and opportunity of a trade agreement with China, right? Known as Phase One. We have a really key area coming up on December 15th. That's when Trump has the ability, or it's a deadline where he has the opportunity to apply another, $500 million worth of tariffs on China on December 15th. So that means the market is, on pins and needles a little bit, but everyone right now is thinking that for political reasons, keep the economy good from a re-election standpoint, that Trump is probably more favorable to at least hold out hope of a trade agreement, and maybe have some, should we say, quid pro quo on maybe China will buy some more agricultural goods in order to keep us from putting on these tariffs, which really helps out both economies. But so the bottom line is there's a potential path forward. But if we don't get that trade agreement and should we say negotiations go south, we can definitely see the market pull back. And the first area that would pull back to more than likely would be this 50 EMA. And from a long-term portfolio standpoint, that's probably not something you're going to adjust on, especially on a news spike. So we just maintain that. The other thing to think about is, what really drives the market these days, and it's the central banks. And if we take a look at the overall assets, what's happening is that right now we are putting together, basically they're calling it non-QE or quantitative easement, but the Fed is pumping in, Federal Reserve Bank of New York is pumping in a tremendous amount of money into the repo market in order to keep liquidity up. And keeping liquidity up, allows us to have different transactions and move credit forward. So basically, since credit restrictions aren't very high, and there's this support by the central banks, not only ours, Japan has also announced another $120 billion type of a buyback. Europe is also making these things, the European Central Bank. They're looking at, as far as January, moving things forward. So the central banks, as they print money, that trumps everything. And it really helps move the market. So near term, we're not there. And you can kind of see that from a liquidity standpoint. Here we go. That from the financial conditions index is that we're really below this line. The shaded areas represent recession, and once you jump over this, that shaded line, you kind of get closer to a recession. Here, in these different areas, we're not even close to that. So we have some pretty smooth sailing. But there are some things that we wanna watch going into the future, and some of those things are the following. So what we have here, let's see, is that the one I want? Yeah. Okay. So we have here is we're looking at the McClellan Index, and the McClellan Index is basically a factor of looks at the breadth. Okay, it's saying are all stocks participating in this movement, and I can tell you that from S&P 500 standpoint, which is a cap-weighted index, that's not true. Microsoft and Apple are kind of the key drivers, and there are some certain sectors moving us forward. And you can see that every single time that once the McClellan Index crosses through this moving average, this green line here, the market tends to start to slide down. And so it's something to keep aware of, right? It slides down here. It slides down here every time we cross. It slides down here. And the inverse is true the other way, right? When it crosses above. So now we're down below, and you can see overall that we have this, we keep getting these lower highs, and we're in this pennant, if you will, of what's happening. So whichever way this wave breaks is going to be an indicator of what might happen in the future. So is it something we need to take action on? No. Like I said before, we're in decent shape, but it's something to watch, right? It's something to say that the market isn't firing on all cylinders, but it's firing on enough cylinders that we don't have to be totally fearful. Let's take a look at kind of a risk-on indicator. So when we talk about risk, we talk about junk bonds and corporate bonds. So when we sell junk bonds, that means people are searching for yield. People are buying those junk bonds because they want to make dollars, given that interest rates are so low. There's a lot of confidence saying that these corporations will actually not default, be able to pay their bonds off, and therefore you can achieve and capture the rate of higher return. And right now, right, we can see that we're definitely, moving upward, but we really haven't kind of crossed this overall, threshold to really show us a huge, total risk on, right? So people are keeping a little bit of cash on the sidelines. They're taking advantage of the overall market returns, from the S&P 500 itself. But from the riskier assets, they're kind of holding status quo. So it's just something that's good to watch. We're not overall exuberance, okay? The same thing that we need to take a look at, we always talk about, our interest rates and our overall yield curve inversion. So you can see here is everyone was freaking out. Oh, we have a yield curve inversion, the market should drop. Well, that's not the way it works. So let's take a step back in history. Let's look back a little bit at these areas right here. And what normally happens is that you have this 12 to 18 month gap between the yield curve inversion, okay, and before things start getting tenuous and potentially going south. So if you look at here, that this yield curve inversion happened, right? This is like kind of in last March, and we're not up and over it yet. We're kind of knocking at the door, kind of at the 12-month level, 12 to 18 months. So it's saying, hey, we need to watch, okay? This is something to definitely consider and what we need to think about going forward. Okay, guys, so in summary, are we green? Definitely. Are there some areas of concern that are creeping up? Yes. Have they been able to, exact any type of influence on the market? Absolutely not. Once these lines cross, does the market suddenly drop automatically 100 points? No. It's a process, right? It's going to happen slowly unless there's some type of catastrophic event. So that's going to allow us, once we monitor the market itself, to adjust our portfolios slowly as the market is, so we don't miss out. We're not going to go from 100% invested to 0% invested in one swipe. We'll start taking defensive measures as far as returning to cash. We'll start taking profits, and we'll start looking at the relative performance of different asset classes and taking advantage of those, because there are asset classes that do perform and outperform, okay, in a bearish type market. Okay, so that's the hint. That's kind of what's going forward to as we move into a more formalized on the brink. You have a good idea of how that's happening. Have a great weekend. Enjoy, and we'll catch you on the flip side.